If you do any kind of research about how to handle a market downturn, you will most likely come across advice that tells you you should hold and stay invested even if the market continues to go down. This advice is usually followed by, if you miss this many days of the recovery, then you're gonna lose or miss out on X amount of returns. For example, if you miss the top 10 best days of the recovery, you're gonna have less than you would have if you were completely invested or you didn't miss those 10 best days. They, in general, basically point out to the fact that it's basically impossible to time the market, and you will most likely miss the best days when it comes to returns during the recovery. But one thing that those same analysis state is that most of the best days of the market during the recovery come after the worst days of the market crashes. So if you're missing the best days of the market recovery, that actually also means that you're missing the worst days of the market crash, right? So in practice, the best days should not have such an impact on you since your portfolio was not affected by the drop anyways. Let me show you something real quick. Let's say that you have $100 invested and the market had a decline or a drop of 25%. You now have $75 on your investments or $75 worth on your portfolio. In order for your portfolio to recover from that 25% drop, the market will have to provide or give you a 33% increase to even make it up. So in my mind, it should be easier to stop the bleeding or stop the losses early and then get back into the market once the market is showing signs that it's actually recovering. Just to make sure that you follow me here, let's say that you have $100 and the market drops by 50%. You will need the market to increase by 100% and kind of get back to the same level where you were before. Not to make more money, just to even get back to the same level. So in order to recover, not to make money, just recover, the market will have to increase by 100% to take your investments back to the same $100. I think that it should be a lot easier to cut or stop your losses when you see the market going down, and just as easy to notice when there's a significant recovery and just buy back into the market. So what I wanted to do is find a way to test this out, test my theory out, right? I wanted to see how can I actually do this. After doing some more research and some more digging, I ended up on TradingView.com. In this platform, you're able to use a replay function and go back to a specific time. And my idea was to see how and when I would buy in and out of the market and see how I compare at the end using this strategy. But to be able to kind of measure my results, the plan was to paper trail and track my performance using different strategies. Paper trading is buying and selling on paper, but not actually using or risking your own money to do the trades. You will record your sells and your buys and track your performance without actually risking any of your own money. TradingView also allows you to actually paper trade. Within the replay function, you can paper buy and sell, and the platform itself will keep track of your actual performance if you are actually doing those trades. Now, we know how the market behaved or performed over the last 10, 15, 20 years. In order to have some kind of unknown, I asked my wife to pick and choose a couple of dates over the last 30, 40 years, and I started my paper trading from those dates, dating back all the way to 1970. So on my test, I started with 5 different dates, and my strategy for timing the market was this. I was going to start with 10 shares of the S&P 500. I would set the charts to have a monthly view. I would sell every time that the monthly closed lower than the prior month. And I would buy back in once I saw a recovery or a month closing higher than the prior month. I was gonna do this for periods of 5 years at a time, and each of those periods starting at a different date in different decades. I kept doing this over and over again, and these were my results. During the first decade, I was able to gain 32% on average over 5 years. Second attempt, I was able to gain 30% over 5-year periods. Third, I was able to gain 22% on gains over 5 years. Fourth test, I was able to gain 37% over 5 years. And my fifth attempt, I was able to gain 40% over 5 years. To me, this approach gave me pretty consistent results. And I was basically able to time the market. What I kind of realized was that missing the best days of the market were also offset by missing the worst days of the market. That records or history kind of shows that the S&P 500 always finds a way to continue to go up or eventually go up again. And keeping in mind that investing is ran and benefits the most big corporations and influential people, it's no surprise that the markets actually behave this way. The markets will always find a way to go back up again and will most likely continue doing so going forward. But that might be for another video. My research and kind of testing still felt inconclusive. I was only looking at one approach, and even though I did not lose any money per se, I still wanted to test the same time frames and use the recommended technique, which is the just buy and hold and stay invested in the market approach, and then compare those results with the results that I got. So let me bring up my own results again. Now, during my first testing and attempt, I was able to gain 32% over 5 years. Now, let's see if leaving those investments untouched for the same 5 years will yield the same results or better or worse. For my first attempt, leaving the investments untouched led to a gain of just 25%. So I was effectively able to time the market during that time frame. For attempt number 2, leaving it untouched, I would have gained 59%. For attempt number 3, instead of 22%, I would have gained 110%, which is a massive difference. For attempt number 4, instead of 37%, I would have gained 48%. For attempt number 5, instead of 40%, I would have gained 39%. So during my testing, 2 out of 5, I was able to beat the market by timing the market. To be honest, I was surprised about the results, but I still felt like something was missing. So I kept paper trading and testing my approach to see how I could improve my strategy and make it sort of predictable or able to be replicated. I did this for a couple of weeks. This is what I found. When looking at periods of 5 to 10 years, this strategy beat the market or was really close to the market performance 4 out of 10 times. But when working with periods or time frames that were 5 years or less, with this strategy, I was able to beat the market 6 out of 10 times. This got me really excited. But one thing that I was failing to account for were taxes, capital gain taxes. Most of the capital gain taxes were going to be considered short-term capital gain taxes, which destroyed any kind of gains that I was able to capture before any major drops. Take a look at this simpler visual. By trying to time the markets since 2005, starting with 10 shares in the S&P 500, by now I would have gained about $28,000 in profits. That is, if somehow I was exempt from paying any sort of capital gains taxes. But anytime that there was a sale, any kind of gains from those sales would be subject to capital gains taxes, and most often were short-term capital gains. At the end, leaving my actual gains after everything is said and done to just about $12,000 in profits since 2005 with 10 shares. In contrast, if I had left my investments in 2005 of 10 shares untouched until now, with all the ups and downs in the markets, including the 2008 and 2020 declines, my gains by now would have been just about $44,000 in gains. That's almost 4 times the returns over the last 20 years. Look, past performance does not guarantee future results, and especially not true when you're looking at the performance of the S&P 500 or the stock market. The past performance of the stock market is inaccurate because what the market is now is completely different of what it was, let's say 10 years, 20, 50 years ago. Think about this. Here are some factors and black swan events that change what the stock market is and how it behaves. In the 1960s, computers started to be used to analyze trading opportunities. In 1971, the dollar got depegged from the gold standard. Also in 1971, computer trading started to be introduced into the stock market. 1978, 401k plans were introduced. That completely changed the dynamics of what the stock market is. In the 1990s, high-frequency trading using computer algorithms were allowed into the stock market. 2001, we had the 9/11 attacks. 2013, Robinhood launched with zero-fee trading, allowing masses to start trading. 2020, we had the pandemic. And on top of that, we also had bubbles, like the dot-com bubble of the 2000s and the housing crash in the 2008. One thing that is clear is that it is in the best interest of people in power with a lot of resources and influence to ensure, and I believe, to force the markets to recover and continue going up regardless of what's going on. So here's my strategy. My strategy is to continue the same plan and get those 90% returns during those 10 best days of the recovery during the year by investing the same or even more if I can when I see markets dropping. That way, at least the new money that I am invested is capturing those 90% gains during the recoveries. All of that without paying any taxes on the gains that I still have. The stocks and ETFs that I'm choosing to invest in are things like SCHD, SCHB, and some individual stocks like Palantir, Nike, Microsoft, Google, and others. Most of my investments are still staying in ETFs, at least for me. But if you want a breakdown on which ETFs could be the best fit for you and your goals, I suggest you watch this video next. Here I compare the ETFs I consider to be the best, and you might be able to find the ones that you're looking for or the one that is missing from your portfolio. Don't forget to like and subscribe. See you in the next video, and let's grow together.